Hey, it's Jeff Garber, mortgage expert. It is December 1st, and we are going to be bringing you more good news today. We've been saying for a while now that November was going to be the turning point. We felt inflation was going to be peaking, and we were right on both accounts. Now, there's two reports that come out each month that measure inflation. We have the CPI, Consumer Price Index, and we have the PCE, which is the Personal Consumption Expenditure. And the PCE came out today. And the PCE happens to be the Fed's favorite measure of inflation. And both the CPI and the PCE did come in lower. Now, what does that mean? Well, inflation's still high, okay, but it's coming down. And when inflation comes down, mortgage rates come down. It's as simple as that. And we've been saying this for a while, but now we can back it up. We can back up what we've been saying with some live numbers. Let me show you what's going on. Gonna get myself out of the way. So what you're looking at here is this is a chart of what are called mortgage-backed securities, and they live in the bond market. And these are basically mortgages that are trading live right now as we speak. Now, as the price goes up in the bonds, these mortgage bonds, as you can see this by my line here of a pretty much a consistent uptrend in mortgage bonds, rate comes down. So if you come over to here, in October, this was about the highest rates got so far. Now, that was around 97. All right. We're now about 400 basis points higher in a little over a month. All right. It's the equivalent to about a point lower in rate. And that kind of happened day by day. Now, look, right here, November 10th, you can see this was the CPI that came out, and the bond market loved it because it was the first reading of inflation that started coming down. This means that the Fed hikes are finally hitting the market and doing exactly what we said they would do, and that is to reduce inflation. But look what happened. Even after the 10th, right, we gave a little bit back, which we usually do. But look, we got it all back, stayed consistent, up and down a little bit. Boom. Yesterday, we think that the Fed Chairman Powell may have had a sneak peek at the inflation numbers that came out today because he made a statement yesterday. And look, we had another monster day, great day with mortgage bonds. You can see a nice big green candle, going from 100 to over 101, big 80 to 100 point increase there, which helps rates lower maybe another 0.25%. And today, with the inflation number coming out, you can see we're still in the green here. And that is good news. We want to continue to see inflation numbers come out in December, January, February. If they hold suit, which we think they will, we feel that the next Fed meeting on December 14th will be a 0.5 point hike instead of 3/4. That's going to be very welcome because those 3/4 hikes, 4 in a row, they were big hikes. And to understand it, when the Fed hikes rates, they're doing that on purpose. They're doing that to slow down the economy. They want to slow down spending because when spending slows, inflation comes down. And for the Fed to say, hey, you know what? We might only have a couple more hikes left, and they're not going to be these big 75-point hikes. Maybe we'll go down to 50 and maybe one more in January, maybe a quarter. And that could be the end of the Fed hikes if our inflation numbers come in good. Well, guess what? We're looking at rates possibly getting back into the fives, maybe even the mid fives by the spring market, or maybe even lower. All right. Many people are shaking their heads. No way, that'll never happen. But we are on path and on target for that. So what does that mean? Well, if that happens, we're going to get buyers off the sidelines. And many buyers are on the sidelines now for the wrong reason. Many buyers feel that rates are going to come down, but they also think housing prices are going to continue to come down, right? But we know, because we've been in this market before, that if rates come down and we all of a sudden get a lot of buyers jumping off the sidelines now because we're past 7.25 and now we're down in the fives or maybe the fours, that's going to be attractive. So we're going to have more buyers. But guess what? Inventory is still low. And that's not going to change. So we are going to be back to the market we were in before rates went up. We're going to have a lot of buyers chasing less inventory. What does that mean, right? Well, unfortunately, we're back to multiple offers, bid over ask, appraisal gaps, and all the contingencies that you have to waive, right? That market could definitely come back. and we need to be aware of that. So it's still a great time to buy right now, even with higher rates. All right, because if you buy a house now and there's less competition on it, and you don't have to negotiate, and you get the house for a good price, we're just going to refinance you later. All right, unless you believe that rates are going to reverse course and go right back up, and inflation's going to just go right back up, then stay on the sidelines. But we're seeing it play out the way we've been saying it was going to play out. We see what's happening. We look at history. We've seen this before. We've seen what the Federal Reserve does. All right. It's no different this time than any other time. This is not 2008. All right. This is, you know, I don't want to say predictable, but measurable. If you follow inflation and you understand how it works and what basket of goods are used to come up with what inflation is, and you're tracking that in between the numbers like we are, that's why we can say, hey, we think the inflation numbers are going to get better because we're following the statistics all along. For example, rents. Rents are part of inflation. Rents are coming down. They've already peaked. Well, we know that that's a part of an inflation number. So if rents are coming down, that's a good sign that inflation numbers could come down. We also know that the worst readings of inflation were about a year ago for the next few months, September, October, November, December. They were high readings last year. All right. So all we need is lower readings now to replace higher readings. And just by simple math, inflation is going to start to come down. We think it's going to be a gradual process. All right. We want to get it back down to the comfort zone where the Fed would like it to be, which is around 2%. Right now, it's still 5-6%, but it was 7%. So as long as it's heading down, inflation is the kryptonite to the bond market. And the bond market is where interest rates live. If inflation is coming down, mortgage rates are going to come down. Now, it's not going to be a steady, we're just going to keep coming down. We're going to have our pockets where they go up and down. We never go in a straight line. But we've had 2 readings of inflation this month that we're very excited about. The bond market's excited about it as well. And we can see that in our rate sheets right now. So that's where we think we're heading. I hope this helps. I know this can be a technical, boring topic, so to speak, but we have to pay attention to the economic indicators more so now than we've had in the past because it is going to affect how real estate, responds heading into 23, heading into the spring market. And so to summarize, we're going to continue to monitor inflation. We feel inflation is going to continue to moderate. And as inflation numbers come out and moderate, mortgage rates are going to come down. At some point, the Federal Reserve is going to stop with their hikes. And remember, their hikes are not mortgage rate hikes. They're short-term hikes. They don't mean that they're making long-term rates go higher. So oftentimes a Fed hike can actually help lower mortgage rates because the bond market realizes that they're doing that to fight inflation. And if they can get inflation down, that's good news. And that's why rates are coming down right now. So we see that continuing. We are hoping that we get the next couple months of readings look like they're going to follow suit. If they do, we're going to head into 23 with rate sheets looking pretty good, which is going to get more buyers off the sidelines. And we're going to be back to more of a market with low inventory and possibly start to see some bidding wars and prices actually going up again. And that's how we see it. That's our call right now. Hope this helps. Any questions, let me know. And I hope you have a great day.